Manishi Raychaudhuri as well joins us on board to talk about his market views. Manishi, hi, morning, and it seems like the pain is pretty much across the globe. What, according to you, is the real culprit, though?
If you look at the Indian markets, there hasn't really been any India-specific reasons which has taken down the market. As you rightly pointed out, the pain has been pretty much across the globe. There are global and regional reasons why the markets, particularly emerging markets, have corrected. It started with the concern on China's slowdown and the asset quality of the Chinese banks, which culminated with the wealth management product of ICBC that, almost, getting defaulted by the end of January. And it's continuing with the emerging market currency crisis, which seems to have accelerated over the last couple of weeks because of country-specific reasons. If you look at a couple of the LATAM countries or Turkey, these currencies have fallen a lot faster because there were country-specific reasons in them. In that context, actually, India hasn't done really that bad. The market from the recent peak is possibly down about 5 to 7%. The currency is still relatively stable compared to some of the other Asian countries or some of the Latin American countries. And I would think that the steps taken previously in trying to curtail bullion demand or gold imports, to be specific, and the swap deals with the banks, the FCNRB accounts, the kind of flows that we had seen there, those things have actually stood the rupee in good stead. I think this trend may actually continue for some time, which means that as far as the currency is concerned, the rupee may continue to be relatively stable compared to its emerging market peers or Asian peers. And as far as the equity market is concerned, possibly this consolidation phase would likely continue for some more time. It's difficult to, kind of exactly draw a line on the sand and say that this far and no further. But, I think at current levels, the market is trading somewhere around 13.5 to 14 times. I wouldn't be surprised if the valuations correct another 5 to 7% from here.
The global fear is all about China. And like, Aisha just pointed out that Chinese are celebrating. They are off for a New Year holiday and the world is worried about them.
Imagine how important they are.
Exactly.
I don't know how to correlate these two.
No, I'm putting facts on table.
The general. Right. See, in case of China, there is one clear problem, which is that the old strategy of investment growth is not working anymore. If there's one data point that I'm very fond of adhering to and looking at and constantly monitoring, which is the ICOR, or the incremental capital to output ratio in China. If you go back about 6-7 years, that was somewhere between 2.5 to 3, which means we needed about 2.5 to 3 units of capital to be invested to generate 1 unit of GDP growth back then. Today, that number stands at somewhere around 6.5 to 7. And that has been the extent of decline in capital efficiency in China. I think the authorities, the Chinese government, they understand that, and that is why they're going towards this immense reform measures which they announced in November last year. The problem is, it takes time to implement these things. It takes time to steer a massive ship away from investments to consumption. And in the interim, we have to bear with much, which would obviously have an impact in the rest of the region, both in North Asia and in South Asia. In fact, I would think that in this context, India is relatively immune. I'm just back from, meeting investors in Asia and the United States. Rather surprisingly, I noticed that there is a degree of enthusiasm, if you will, in favor of India. Which is paradoxical given the macroeconomic headwinds that India still faces. But, in a sense, Indian market has become kind of a default choice, where you still have about 15, 20, 25 companies which are growing at a reasonable pace, which seem to offer some degree of decent management quality and growth, and after all which tend to benefit from currency depreciation and the the better growth in developed economies. And I'm talking about the exporters here in IT services, pharmaceutical, and the merchandise exporters. So I think there's this relatively small set of stocks that investors are still willing to play, and India in that sense offers a decent choice by default.
So,
take a look at the metals name. In fact, as we speak, all sectoral indices on the BSE as well as the CNX are in the red. The realty index taking a sharp knock, down by about almost 2%, and the metal space as well is taking a hit of about almost 3% as we speak. Pharma too on balance, by the way, it's still in the red. So all sectoral indices are showing you red ticks right now. So Manishi, going by your view, what does one do? Should one buy and nibble into the market on dips?
Well, it may be too early for that, because as I said, that the Indian market is going down not because of India's specific reasons, but because of global turmoil, and one doesn't really have a strong view on how long this could continue. Historically, we have seen that these episodes of global risk perception increasing, they turn out to be somewhere between maybe 2 to 3 weeks or a little more than a month, and they also lead to slightly more significant corrections in the emerging markets than we have seen now. So if one is a trader, if one is sensitive to about 5 to 7% correction in equities, then one should possibly hold his horses right now and not jump into the market right away. Having said that, once we have had that consolidation, once we have had that correction, there are stocks in India that would offer good value. I would still stick with the exporters, the IT services pack, for example, because I think the fundamentals are indeed getting strong there. The rally or the outperformance that we saw in 2013 was predominantly because of the currency depreciation. I think now we are beginning to see the impact of demand increase coming into the IT service stocks. I would expect that to continue for pretty much the first half of this year. Even merchandise exporters, you named Tata Motors, that's one bright spot where I think the sales in the developed markets and in China continue to grow quite strongly. And apart from that, one should also look at a select set of private sector banks, especially after this recent decline, the banks which are not so much dependent on wholesale funding. And also a very select group of oil and gas companies and possibly the utilities, particularly those utilities which are not dependent on, which are basically there's a regulated return on those utilities, the likes of NTPC or Power Grid. So, there's a select list of Indian stocks. I mean, that makes up, I think, about 15 to 20, which would still give, I think, decent returns, maybe not in the very near term, but over the longer term for investors.
Why should one buy into IT stocks, Manishi? And I'll give you a couple of factors which you need to really consider here. A, that's a crowded trade. B, if China slows down, that could be because US export demand is slowing down, and we don't know where actually US is also headed.
Right. You see, as far as IT is concerned, one of the best indicators I tend to follow, possibly there are a couple of them, but these two are the Philadelphia Fed survey of capex intentions by the US companies and the ISM, which is essentially the PMI for the US companies. Both of these have been indicating a pretty significant pickup of capex by the US companies over the next 6 months to 1 year. One has to analyze what this means. So when the Philadelphia Fed asks a vast swathe of US companies, what's your capex intention for the next 6 months? And when this indicator moves up for the last 15 months, remember that it bottomed out in October 2012, it means that these companies which are operating at a relatively low capacity utilization, they're not possibly talking about enhancing their own capacities. They don't need to do that. What they're quite likely talking about is productivity enhancement, which essentially means investing in technology. So it's the Korean DRAM manufacturer, the Taiwanese chip maker, or the Indian IT service provider which are likely to be beneficiaries of this enhanced demand.
Fair point.
And I think that's the element, that enhanced demand element is something that we haven't seen in the stock prices yet.
What is your take on flows? Because for 2014, if I map the flows have not been very strong. The basic assumption for 2014 was that liquidity will remain benign, but that key basic big assumption is now coming under threat.
No, I agree. We also started with the assumption that the foreign flows into equities, as far as India is concerned, they would be in the range of about 18 to 20 billion, which has been the normal rate for India, give or take a few billions. I mean, there have been very strong years in between, like 2010, and there's been a couple of weak years. But the average has been that India tends to get about 25 to 30% of the Asia ex-Japan FII flows. Now, going by the same proportion, in the near term, it seems doubtful whether that run rate of around 1.5 to 2 billion per month would be maintained. I would think that the first half is relatively questionable, because the concerns about the pace of tapering and the consequent concerns about flows into emerging market funds are likely to remain. Over the last 3 months or so, we have actually seen emerging market funds losing money in favor of global funds and the developed market funds. I think the first half would remain, we'll continue to see that seesaw ride in the first half of the year. I still believe that once investors get a sense of the exact pace of tapering, and that should become relatively clear by the first or the second quarter, things should pick up in the second half. We also need to see some inflection points as far as return on equities in emerging markets are concerned, and that, I believe, would be reached in the second half of 2014. And as a consequence, this confluence of both fundamentals and relatively more benign view of flows should lead flows to reach a slightly better or a higher point in the second half, but we should tighten our belts in the first half.
Manishi, really good chatting with you. Appreciate you taking the time out and getting us some perspective and some sense of this weak market.